Welcome back to the channel, everyone. Today I want to talk about how employees are currently snitching on hedge fund managers like Bill Hwang of Archegos Capital Management right now. And I also want to talk about another stablecoin that has just depegged and has been crashing over the last 24 hours. So stay tuned and let's make some money. And now I want to dive straight in with the key information. So, the men that just flipped on Bill Hwang were trusted hedge fund lieutenants. William Tomita recently pledged guilty in the Archegos trading debacle and formally turned on his longtime boss, Bill Hwang. Scott Becker had also arrived to plead guilty and officially flip on Bill Hwang, the enigmatic investor accused of masterminding a vast criminal scheme to mislead banks and manipulate markets. It says Tomita and Becker were virtually unknown in financial circles, but now they'll play a key role in the prosecutor's case against Hwang and Patrick Halligan. Tomita and Becker have recently cut deals on Saturday in the hopes of avoiding prison or at least shortening their terms. Hwang and Halligan have still pleaded not guilty to a range of charges, including racketeering. Crazy enough, it says back in 2013, Bill Hwang pled guilty to wire fraud relating to illegal trading in Chinese stocks and shut down. While Tomita wasn't back then named by US authorities, the Hong Kong regulators did actually charge him with helping Hwang commit insider trading, but he was cleared in 2013. Despite that close call, that year Tomita stayed with his boss as he helped open his family office, Archegos Capital Management, over in the US. And right now in 2022, Tomita has actually pled guilty to 5 counts, including conspiracy, fraud, and market manipulation. Each crime carries a maximum of 20 years in federal prison. I think this is a great move in the right direction. Even though Bill Hwang is still pleading not guilty, his top 2 lieutenants have flipped on him and have started to snitch. I don't think it will be long until these top lieutenants end up flipping on other hedge fund managers in the industry, or until Bill Hwang himself starts talking about how other hedge fund managers are committing the same crimes. Obviously, if Tomita and Becker can reduce their sentences by snitching on other top hedge fund managers, they most probably will, as it will give them the opportunity to see their family again in the future. And it also wouldn't surprise me if Bill Hwang even follows the same route when these court proceedings get underway and his outlook starts looking more and more negative. I think as these court proceedings continue on and it's looking more and more likely that he will end up in jail, it wouldn't surprise me if Bill Hwang starts snitching as well. I imagine Bill Hwang will start talking about other large hedge fund managers that have either helped teach him about his crimes that he's been committing or are also committing the exact same crimes. I think these arrests will only continue amplifying into the future as the market continues its crash and more money is wiped out from the stock market. Speaking of which, Goldman's Lloyd Blankfein says the US currently has a very high risk of recession. He said this risk of recession is not baked into the current S&P 500 pricing and the policymakers have a very narrow path. He said if I were running a big company, I'd be very prepared for it. And also if I was a large consumer, I'd also be prepared for it as well. His comments were broadcast on the same day as the firm's economists cut their US growth forecasts for this year and next year to reflect the recent shakeout in financial markets. Looking at the S&P 500, I did expect another day of the market continuing to move upwards, but it looks like the market crash has already resumed and could be setting new lows over the next week or two. I think this is only going to be aided by yet another stablecoin depegging and starting to crash. I did say that Tether would be the next stablecoin to crash over the next week or two, but it looks like DEI is being the first, already crashing here on Monday morning. Guys, be sure to sign up to Moomoo using the link in the description below to get up to $17,500 in free stocks. Moomoo and Futu also officially do not accept payment for order flow, which is brilliant for buying those AMC shares. Moomoo was also recently voted the best trading platform because it's incredibly easy to use and very customizable. DEI lost its peg on Sunday afternoon and through Monday has continued to crash, at some point hitting lows of nearly 50 cents per coin. Importantly, DEI currently has a market cap of around $5.2 billion. Before the depeg, the market cap was around $8 billion. Now importantly, that is around half the size of the UST market cap before the implosion of around $15 billion. So it's around half the size of UST. But again, this could be very quickly another $5 billion that's just wiped off the face of the crypto market in only a few days. Again, if these stablecoins continue to depeg and to crash, it wouldn't surprise me if Tether ends up crashing before the end of the week. And importantly, the Kabesi letter has also compared the Nasdaq market crash in 2022 to 2020, 2008 and the year 2000. He said so far we're only 119 days into the sell-off and the Nasdaq is down 29% from its peak. 119 trading days into the 2008 and 2000 sell-offs, the index was only down 17% and 19% respectively. Importantly, we can see from this chart that even though in the year 2000 the Nasdaq did fall nearly 80%, it fell nearly 80% in 648 days. Again, in 2008, the Nasdaq fell by nearly 60%, but again, it fell nearly 60% in over around 350 days. So far into 2022, the Nasdaq has already fallen 13% in only 119 days and looks to fall much further over the next 119 days or more. It wouldn't surprise me if we end up falling down 60 or even 70% over the next 3 months. And he even tweeted saying, how is the Fed still calling for a soft landing, even though the Nasdaq is already down so much more than it has been previously? As I noted a few videos ago, we can also see in the year 2000 and in 2008, the crash did start, but we did have some minor pullbacks during the overall crash. Obviously in 2008, the Nasdaq fell over 20%, but then recovered to only being down by 10% before falling down 40% and even more. The same can be seen in the year 2000. The Nasdaq nearly fell 40% before recovering to only being down around 15% before falling to being down 70% and then nearly down 80%. And therefore, while we may see a small recovery in the Nasdaq and the S&P 500 over maybe the next month, it wouldn't surprise me if in the next 3 to 6 months, the Nasdaq has fallen much more severely. Crystal Ball has also tweeted saying the Motley Fool just sold $128 million worth of pooled investments filed March 29th. And he said the Motley Fool are currently selling a lot of stocks, and he wonders if this is a liquidation or a margin call for their short positions. While I'm not really sure if the Motley Fool are shorting AMC directly or are holding tons of AMC synthetic shares, they are absolutely selling off their long positions, clearly preparing for a market crash. Obviously, this filing was on March 29th, and therefore this is their activity for Q1 of 2022. Through Q1, so January, February and March, the Motley Fool sold off $128 million worth of investments. So clearly, back in Q1, the Motley Fool were absolutely preparing for this current market crash, and the market is absolutely still crashing. I think if we're even seeing the mainstream media selling off their stocks, I think a market crash is absolutely happening right now and is expected to continue just around the corner as well. And I also want to talk about the importance of AMC call options during the squeeze and how Citadel are likely not taking our call option money each and every week because they have better things to do where they can make more money. Now, obviously, I'm not saying to YOLO into massively out of the money call options on the Friday morning that expire on the exact same day. I do think it's important to wait for AMC to start making a move upwards and then compound that move upwards with call option purchases. I don't think it's a good idea to try and catch a falling knife, as it were. While AMC is falling down, we should not be purchasing the $50, $60 and $70 strikes. We should be waiting for AMC to start making a move upwards and then be purchasing in the money or at the money call options to compound that gamma squeeze upwards. Mickey tweeted saying they don't want your premium money. If Citadel needed quick liquidity, they can just pump a random crypto coin, or even destroy a massive crypto coin like Luna, wiping out $40 billion worth of market cap in only a few days. Obviously, it's rumoured that Citadel made upwards of over $1 billion just on their Bitcoin short position, let alone on their UST and Luna short positions as well. If you think about it, when AMC has a week of large call option purchases, the options chain holds around 100,000 options. Let's say that each of those options averages at around $100 to $200 each. That's only around $10 to $20 million generated per week if the entire options chain expired out of the money. Now, obviously, it's never happened that the entire options chain has expired out of the money because AMC has never closed under $1 over the last few years. And therefore Citadel probably only makes say $5 to $10 million from the AMC options chain if they've sold every single call option. On the other hand, Citadel can make well over $1 billion in the exact same time, if not even faster, by destroying a random crypto coin like Luna. I think it's important to remember that short sellers are the ones actively avoiding Gamma and the options chain each and every week by downloading the data on a daily basis. This is directly from a short report that says remarkably things got even worse in the first quarter. The aggressive buying of short dated options produced the Gamma squeeze. The idea was that short dated options could force market makers to buy huge quantities of stock if the stock were to rise. It says the most important variable for many stocks became open interest in weekly options. They said the most notable Gamma squeezes were in GameStop and AMC, and these Gamma squeezes were caused by short-dated options. And therefore it's these hedges that are still petrified of short-dated options. It's not the other way around, where hedges are making money from us every single day because they've got better things to be doing. I've also shown you this chart before of AMC running up back in January as a result of the massive purchasing of call options. AMC also run up in May and June, again due to the massive purchasing call options. Between February and May, all we did was buy and hold, and between July and now, all we've still done is buy and hold, and AMC hasn't yet run up again. Although saying that, back in March when AMC did run up to $34 per share, we again were purchasing those call options, just didn't purchase them in large enough quantities to cause another Gamma squeeze. Toolman Trades also tweeted a thread on why options and Gamma ramping are important for squeezes. And he said when a large number of traders buy short-dated, at the money or slightly out of the money call options on a stock, that forces market makers to delta hedge. Delta hedging combines the purchase or sale of an option as well as the underlying asset itself. They typically delta hedge in order to reduce the risk of getting blown out in the event of the underlying asset skyrocketing or plummeting. But I think it's also important to remember that market makers don't necessarily hedge when we buy the options. They can potentially end up dropping the ball or fumbling the bag and be forced to catch up at a later date. For example, if AMC started to move up today, we'd start buying our options today on the Monday. But it's important to remember that these market makers may not hedge and buy the underlying assets today on the Monday as well. If AMC continued its run up, we'd also continue purchasing these options on Tuesday, Wednesday and Thursday. But importantly, market makers may not actually perform this hedge and may not buy the underlying stock on the same day on Tuesday, Wednesday and Thursday. Obviously, if AMC is still moving upwards on the Friday, again, we'd continue to purchase more AMC options, and the market makers would be in a terribly sticky situation as they haven't hedged for any shares or any options so far that week, and they'd have to hedge for all of the options all at the same time on the Friday morning. Now that obviously caused the price of AMC to rocket up in a very short space of time if these market makers had to buy hundreds of millions of shares worth of AMC. And he said the more widespread the buying of these short-dated call options, the more the market makers have to delta hedge and buy more AMC shares. This can even be seen directly in AMC. The widespread buying of call options happened right before the June run-up, and that in itself is evidence that call options do not hurt us. We can see here right at the end of May, there was a massive increase in the purchasing of call options, which obviously caused the June run-up. I do think it's important to not be swayed and convinced that call options are bad for the AMC squeeze, because they are good for the squeeze and typically what causes AMC to run up so fast. Unless these retail investors like you and I have enough cash left over to purchase hundreds of millions of AMC shares, which I for one don't because I've already spent my money buying more AMC shares, then AMC will not run up that quickly. The only way that we can ensure that hundreds of millions of AMC shares are purchased all at the same time is to buy call options when the price of AMC is moving up, amplifying that move upwards. Guys, be sure to leave a comment down below and ding that notification bell because that way you'll be alerted when I upload a new video. Cheers.